It takes us to our talk of the tape. What expected rate cuts will do for the markets and whether it is time to add to stocks or move money into bonds as that trade gets more attractive to some. Let's welcome in Jan Hatzius. He is the chief economist and head of global research at Goldman Sachs with us here at Post Nice. Nice to see you.
It's good to see you, Scott.
So we're good on the inflation front, right? Is that your takeaway from the last couple of days? Now we just have to get our sights on this labor market and make sure that hangs in?
That's right. The news flow was good. PPI, CPI, we take it together. We get 14 basis points for core PCE in July. That's a continued encouraging number. Certainly gives the green light for a cut. And I think how much they will cut is going to depend on the labor market numbers. Our baseline is 25 basis points. If you see a somewhat stronger report than what we got a week and a half ago, no further increase in the unemployment rate, and claims consolidating in the sort of 230,000 range or so. Yeah, I think that would give you 25, but 50 is possible.
What happened a week ago Monday? Was it a panic attack on the economy? Was it overdone? Are we making too much about one relatively soft employment number that wasn't even that soft?
Well, it was soft, and we did think that it warranted increasing our, risk of recession somewhat. We moved from 15% to 25% over the next 12 months. But at the same time, it is only one number. 25% is still not a high number. It's below consensus. Continued expansion is still significantly more likely. So, yes, I would put it into perspective. Obviously, there have been some large surprises, large moves. We had a Bank of Japan rate hike the week before. We'd already seen some pretty sizable moves in some markets. But as far as the economy is concerned, most of the news, I think, is still very encouraging.
But that one jobs number forced you to raise your recession projection from 15 to 25. It moved the needle enough in your mind that now you're on alert?
No, I mean, we're always on alert, obviously, for surprises.
Yeah, but you go from 15 to 25, that gets people noticing that, now you think there's a 25% chance we actually could go into recession when people think, the economy is still reasonably strong. Atlanta GDP now was, 2.9? We still added 114,000 jobs in July. It's not like we added a handful.
Yes, there's always some risk of recession, so I'd never go to much below 15%. That's the unconditional probability. And we thought with the cumulative increase in the unemployment rate that we've seen since April 2023, 0.9 percentage points, historically, that's a strong predictor of recession. I would put some weight on that. But again, I wouldn't put that much weight on it because 25% is still a pretty low number.
Sure. So 25 basis points in September. And then what thereafter? How many times are they going to go this year and by how much?
We have 3 cuts of 25 basis points, so a series of cuts, and then probably continued cuts in 2025, although there are, of course, a lot of uncertainties about what happens in 2025. The economy, what happens in the presidential election, what happens in Congress, what the policy consequences are. But the funds rate is high. 5 3/8 is a high funds rate with inflation largely back to the target, and the labor market rebalanced. There's no longer a need for a 5 handle on the funds rate, and probably will end up being in the 3s rather than in the 4s.
I mean, they're too restrictive now,
yes,
aren't they?
That's right.
What should they have cut in July?
We thought so, and I certainly think everything that's happened since the July meeting has strengthened that view. We wrote a piece titled Why Wait in the run-up to the meeting. So I think they need to get going. They will get going and probably move at consecutive meetings.